was selling US Treasuries, but who was it? Was it China, Japan, Europe? Let's take a look. So here in white, we see the US 10-year yield. We know it rose dramatically over the week here. In red, we see the Chinese currency over the dollar. So as this line goes down, the Chinese currency is weakening. As it's going up, the Chinese currency is getting stronger. In purple, we see what's called an interest rate differential. This is basically the difference between the Chinese 10-year yield and the US 10-year yield. This is one of the primary valuation metrics that currencies trade on, called an interest rate differential. Basically, the concept, the thinking is, if you can get a better yield in China than you can in the U.S., right? If this line is going up, money should flow into China, and money does flow into China. This applies generally speaking for all currencies. So what do we see? This goes back to the 18th of March. So we see, generally speaking, that there is a pretty strong correlation between the Chinese currency, the strength of the Chinese currency, and the interest rate differential. It's not perfect. It's not one-to-one, but I figured this would at least be an interesting concept to make a video about, because I did notice this divergence here. So Thursday is when it started, 10 a.m. Beijing time, which I think is notable, that it wasn't, the middle of the night for China when this started to diverge. So we see here that as the interest rate differential was falling, right? So the Chinese yield was, falling versus the 10-year. The Chinese currency weakened, and this makes sense. And then we see it kind of bottomed here. And then the Chinese yield started to bounce a little bit, as did the currency, but then something happened here around 16, which would be 4 p.m. Pacific Coast time. And they started to diverge. The interest rate differential started to diverge from the strength of the currency. And we also see that the 10-year yield started to move higher. Clearly, it was moving higher the entire week, but it had been, people had been buying the 10-year here. The yield was coming down, and right around here was kind of this divergence where the interest rate differential diverged from the Chinese currency, and the 10-year yield started to sell off, or the 10-year bond started to sell off, and the yield started to rise. So what are the mechanics of this if this is indeed indicative of China selling? China has US Treasuries. That's a dollar-denominated asset. They sell those treasuries, receive dollars, but they don't want dollars anymore. Say they want gold, or they want yuan, which is their currency. So they sell the treasury, get dollars, but they don't want the dollars, so they sell the dollars, leading to weakness in the dollar, and weakness in the 10-year bond, meaning yield goes up. Then, after selling the dollars, they're buying yuan. So yuan strength, CNH strength. So that's pretty much exactly what we see here. Started Thursday morning for them, because the next day. So Wednesday here in America is Thursday over there. So yeah, that's what we see. Is it enough to say definitively that they were dumping US Treasuries? Not so sure, but it is an interesting divergence. China holds about 10% of the foreign held US Treasury debt. Japan holds about 10%, and the European Union holds about 10%. I think the European Union's 12 or 13, but essentially about 10% for each of the three. So this is not what you would expect to see. You would not expect to see the Chinese currency strengthen as the interest rate differential is falling. You can see, especially kind of in the days prior, it had a really tight correlation here, where as the interest rate differential in purple, as that fell, the strength of the Chinese currency fell. And they both bottomed, pretty much right at the exact same time. And as the interest rate differential started to increase versus the 10-year, the US 10-year, there was strength in the Chinese currency. So this divergence here, certainly notable. So let's take a look at Japan. Or let's do Europe first. So I have here in green, the British, French, German, and Spanish and Italian 10-year. So I add the formula is to add all 5 of those and then divide by 5 for an average. So this is the average European 10-year bond yield in green. And we can add the euro. Make this red. So here in green, again, is the average 10-year yield for Europe. And I know there are other countries in Europe, but I just picked those 5. Those are kind of the 5 main ones. And then in red, we see the strength of the euro versus the dollar. So same thing as the chart before. When this red line is going up, that means the euro is strengthening versus the dollar. So what we'll do, okay, I already had it. So in green, it's the average 10-year yield for Europe minus the US 10-year yield. So it's the same exact concept we were looking at before, interest rate differential. As this starts to widen or increase, as the interest rate differential starts to increase, the euro should see capital inflows leading to a strengthening in their currency. And sure enough, that's what we see. So here we see this bottom, and as the interest rate differential versus the US 10-year increases, capital flows into the euro, and this red line, which is the euro, starts to strengthen. But we see around the same time, we see a similar divergence, where it's a little earlier. Kind of in this range. We see the interest rate differential kind of actually start to decrease, but euro's strength, right? Euro is in red, and the interest rate differential is in green. So these should follow the same correlation. It's hard to say exactly when the divergence started. You could kind of pick this general range here, which would have been Tuesday, so Wednesday, European time. But it certainly was diverging here, kind of in this range, in between here. So was it Europe? They hold about 10% of foreign held US Treasuries. Same mechanics as with China. Europe holds US Treasuries. That's a dollar denominated asset for them. They don't want to hold Treasuries, so they sell Treasuries, meaning the 10-year yield goes up. Now they have dollars, but they don't want dollars. They want euros. So they would sell the dollars to buy euros, meaning this red line would go up. Euro strength, dollar weakness. And again, it corresponds. No matter when you pick the divergence, there was so much. The 10-year yield was moving higher so much that it doesn't really matter whether you choose to pick this kind of period as the divergence or back here. The euro was strengthening, generally speaking. So this corresponds to selling U.S. Treasuries, meaning this white line goes up, the 10-year yield goes up, because remember, bond yield is inverse to the value of the actual bond. So if bonds are getting dumped, the yield will actually go up. They were theoretically, at least according to the interest rate differential, this kind of quick and dirty interest rate differential. It makes logical sense, just like it did with China. They're selling U.S. Treasuries, leading to the white line to go up. Now they're getting dollars, but they don't want dollars. They sell those dollars to buy euros, and you get a divergence where, again, the interest rate differential here in green basically was falling for pretty much an entire month. So really, the euro shouldn't have been strengthening on an interest rate differential point of view, which is, again, one of the main valuation components of a currency is the interest rate differential. So it was generally speaking falling. So we should have seen euro weakness, and we did in the early part of the month. We did see kind of generally speaking euro weakness, but then all of a sudden, kind of around here, Wednesday, which would be Thursday in Europe, Wednesday in US time, we see a divergence where the euro starts to strengthen pretty notably, even though the interest rate differential is declining. And it also does correspond to the 10-year yield going up, meaning the 10-year bond value down. So now let's look at Japan. And again, they all hold about 10%. So here we see in red, same concept, which is the interest rate differential, the Japanese 10-year minus the US 10-year in red. And we'll add the yen. Let's do, trying to find a color that, maybe that, let's do purple. So again, same concept. The red is the Japanese 10-year minus the US 10-year, meaning as this line declines, as the red line declines, the yen should weaken. And the yen, let me make sure I had it. Yep. So the yen in purple should decline, meaning yen's weakness, dollar strength, just generally speaking. But again, we notice kind of a divergence where around this time period, the interest rate differential for the Japanese 10-year minus the US 10-year was declining, meaning the Japanese 10-year was giving less yield relative to the US 10-year. This red line was declining, but somehow we were seeing yen strength. And again, it corresponds to a period of time in which the US 10-year bond was getting sold, meaning, again, remember, it's inverse. The yield is inverse to the value of the bond. So again, same mechanics. The Japanese hold a lot of US Treasury debt, and it's dollar-denominated debt. If they don't want to hold dollar-denominated debt or dollar-denominated assets anymore, they would sell the US Treasury, leading to the white line to go up. They'd get dollars for that transaction. They would take those dollars, sell them to buy yen, meaning purple line goes up. And that's exactly what we see. Again, same kind of period of time where we start to see a divergence where the yen is actually strengthening. Say it's slightly later in the day. The yen starts to strengthen even though the interest rate differential is declining. Now, this is only the 2-hour chart, and this is only, 12, 24, 48 hours worth of data. Sometimes these sort of things lag, but generally speaking, it can be an indication. So at least the concept, I think, is interesting to do a video on, to kind of help to educate people how currencies are valued, what an interest rate differential is. But according to what we just went over, it looks like China, Japan, and or Europe could have all been selling US Treasuries because all three of them had decreasing interest rate differential, meaning money should have been flowing out into the dollar. All three of their currencies should have been weakening, but instead they were actually strengthening. And it was in a period of time in which the US 10-year bond was getting sold, yield up. So at least according to this, now, of course, there are so many, when it comes to the international FX market, There's trillions of dollars of currencies traded every single day. I think the number is $7 trillion traded every single day in the FX market. There's a number of drivers of capital flows in the FX market. This is just kind of one very simple, very quick and dirty way to look at it that I thought was interesting because no one really knows. Everyone's been asking this question over the past few days. I had noticed this Chinese, I hadn't looked at Japan or Europe before today, but I'd noticed this divergence because I've been watching the yuan very closely over the past week or two since the Chinese PBOC, the central bank in China, had noted their intention or the possibility of devaluation of their currency. I've been watching it pretty closely. And so I did notice this divergence on Friday. And I thought it might be an interesting concept to explore with Japan and Europe too. But, there's this theory floating around on Twitter on X, that there was this coordinated sell that all these other countries kind of got together to coordinate dumping of US Treasuries. And I don't know, at least according to interest rate differentials and the value of each of these currencies, there's some logical validity to support that. These interest rate differentials are moving in the opposite. The currency and the interest rate differential are moving in the opposite direction that you would expect them to. Now, again, it's super important to remember that this is a very short time period that we're looking at, and there are other drivers like economic data releases, just general kind of trade flows, just for other purposes other than kind of investing or because generally the theory here is that money goes where it's treated best. So if there's a higher yield in, say, America versus Europe, money will flow into America, right? This leads to a strengthening of the dollar, and theoretically, all these kind of imbalances should balance out on their own. The money flows into America, right, in that example. So most likely into U.S. government bonds, meaning the yield comes down, and eventually the 10-year yield is not higher than because so much money is flowing into U.S. government bonds that the yield comes down. So now money is not treated better in America than it is in Europe, say, in this example. So money starts to flow out, right? And it's kind of this constant rebalancing, this constant fluid dynamic that is going on basically 24 hours a day, 5 days a week. But we see a pretty clear divergence in this past week where interest rate differentials and currencies were not really doing what you would expect them to do. All three, Europe, China, and Japan, their interest rate differential, the yield that you would get in those three countries was actually falling versus America. So money would be treated worse in these three countries, but yet their currency was strengthening, meaning where was that money coming from? It wasn't kind of hedge funds or currency traders or anything like that. Maybe it was, who knows? But generally speaking, that's not what you would expect. You would expect those types of people to be pulling money out of those three economies, those three currencies, because the interest rate differential was falling versus America's. But yet, all three of their currencies were strengthening. And it was during a period of time in which the US 10-year bond was selling off. So was it central banks? Was it foreign businesses, foreign banks? It's impossible to say. We won't know until the tick data comes out, and I believe that's in 5-6 weeks. This is Treasury data that's put together by the US Treasury Department that collates the foreign holdings of US Treasuries, and it's on a quarterly basis, so you can see which countries are increasing holdings, which countries are decreasing holdings, all that kind of thing. So we'll know definitively 4, 5, 6 weeks from now. But until then, this, at least to my knowledge, is probably the best way to try to estimate answer to the question of who is selling. Now, of course, as we've said in other videos, there's also the basis trade element to this. There's also the kind of broad-based deleveraging aspect to this. There's a number of factors that could have led to the 10-year yield doing what it did over the week. But we know that there was foreign selling. Because why? Because the dollar was down. So again, the people that are saying, and some of these people I respect a lot, but the people that are saying that no foreigners were selling, well, that makes no sense. I'll do TLT so it's a little bit easier. Because bonds were getting sold and the dollar was getting sold. So I don't see how there couldn't have been at least some degree of foreign selling. Because if it was just domestic, if it was, like we said in our video on Friday, if this was just US banks, US hedge funds that were degrossing and deleveraging due to margin calls, why would the dollar be down? The dollar would actually probably most likely be up, is generally what you see in those kind of conditions. But yet the dollar was down, meaning someone was selling out of dollars as people were selling out of bonds. So this is generally what you see when foreigners are selling. And we just went over all three kind of the major blocks, China, Japan, and Europe. And we know that their currencies were strengthening at this time, even though they really shouldn't have been due to the interest rate differentials. The interest rate differentials were actually going in the opposite way that you would expect, but yet their currencies were strengthening. So again, it's impossible to say today until we have that tick data. But this is one way to try to at least explore the concept of foreign selling. And I don't know, there's definitely some credence to the theories that are floating around on X from what I can tell, just due to these, what we just went over with the interest rate differentials for those three countries. So hopefully that was helpful, interesting, maybe educational. That's really our only goal. So see you guys later.